Understanding credit scores and how to improve them. Understanding credit scores is essential for managing your financial health, as they play a crucial role in determining your eligibility for loans, credit cards, and even rental agreements. A credit score reflects your creditworthiness based on factors like payment history, credit utilization, and the length of your credit history. By learning how these factors influence your score and taking proactive steps, such as paying bills on time, maintaining a low utilization rate, and avoiding unnecessary credit inquiries, you can improve your credit score and secure better financial opportunities. What is a credit score? The three-digit number that represents your creditworthiness, or the likelihood that you will repay money that you have borrowed in a responsible manner, is known as your credit score. This score is determined by lenders as a means of determining the level of risk associated with granting credit to you. Higher scores indicate a lower level of risk for lenders. A person's credit score can range anywhere from 300 to 850, with a higher score increasing the likelihood that they would be approved for loans, credit cards, or mortgages at favorable interest rates and terms. Key factors affecting your credit score. There are a number of criteria that go into determining a credit score, and each of these factors has a unique impact on the final result. Payment history accounts for 35% of your credit score, with on-time payments contributing to a higher score and late payments or defaults contributing to a lower score. This ratio should be kept below 30% at all times. Credit usage, which accounts for 30%, is a reflection of how much of your available credit you are utilizing. When it comes to the length of credit history, older accounts are advantageous because they provide a longer track record of responsible credit use over a longer period of time. The term credit mix refers to the fact that you handle a number of different types of credit, and having a diversified mix implies that you borrow responsibly. Last but not least, new credit inquiries account for 10% of your credit score. If you have a high number of inquiries in a short period of time, it might have a poor impact on your credit score. Maintaining a healthy credit history, paying your bills on time, and limiting your credit utilization are all elements that will help you keep your credit score in good shape because they are all interrelated. How to check your credit score. There are a few different avenues via which you can access your credit score. Free credit scores are frequently made available to customers by financial institutions and credit card companies as part of the services they offer. Credit bureaus, such as Experian, Equifax, and TransUnion, make it possible for you to view your detailed credit report and score, frequently providing you with additional insights on your credit history. Free online tools, such as Credit Karma and AnnualCreditReport.com, also provide access to your credit score and reports, sometimes providing you with additional features such as alerts or monitoring tools to track changes in your credit profile. Through the use of these alternatives, you will be able to successfully manage your credit and remain informed. Number 7. Reduce credit card balances. To maintain a strong credit score, aim for a credit utilization rate below 30%, which is the ratio of your credit card balances to your credit limits. Keeping this percentage low shows lenders that you're managing credit responsibly and not over-reliant on borrowing. Paying off high balances not only reduces your utilization rate, but also directly improves your score over time. Consistently managing your balances and avoiding maxing out your credit cards are key strategies for financial health. Number 6. Avoid opening too many accounts. Due to the fact that multiple hard inquiries might bring about a decrease in your credit score, it is essential to restrict your credit applications to only those that are really necessary. When you apply for new credit, the lender will do a hard inquiry, which will remain on your credit report for a period of up to 2 years before being removed. For a short period of time, an excessive number of queries can be an indication of financial instability, which can have a negative impact on your score. Number 5. Keep old accounts open. Due to the fact that multiple hard inquiries might bring about a decrease in your credit score, it is essential to restrict your credit applications to only those that are really necessary. When you apply for new credit, the lender will do a hard inquiry, which will remain on your credit report for a period of up to 2 years before being removed. For a short period of time, an excessive number of queries can be an indication of financial instability, which can have a negative impact on your score. Number 4. Dispute errors on your credit report. Inaccuracies in your credit report, such as inaccurate balances, accounts you do not recognize, or any irregularities in payment history, should be checked on a regular basis. It is necessary to do this. It is possible that you are not to blame for these inaccuracies, which might have a bad impact on your credit score. It is important that you report any inconsistencies that you discover to the credit bureaus, whether they be Experian, Equifax, or TransUnion, so that they can conduct an investigation and make the necessary corrections. Errors can often be contested online through the website of the credit agency, and the bureau is obligated to remedy the issue within a predetermined amount of time. Maintaining your creditworthiness can be aided by paying attention to the accuracy of your credit report. Number 3. Build a positive credit history. In the event that you are new to the realm of credit, the utilization of a secured credit card is an excellent technique for developing or improving your credit score. Specifically, this is due to the fact that it provides a low-risk alternative for demonstrating good financial conduct from a financial management perspective. When it comes to secured credit cards, a security deposit is the minimum amount that is required. This deposit acts as your credit limit and reduces the risk that lenders are exposed to as a result of your borrowing. In order to demonstrate that you are responsible and consistent with your usage of credit, you should make use of the card on a regular basis for making little purchases and pay off the debt in full each month. This not only helps you avoid interest fees, but it also helps you create a good payment history, which is a vital component in the process of increasing your credit score over time. In other words, this helps you avoid any costs associated with interest. Number 2. Diversify your credit types. Because it is a reflection of your long-term financial behavior, including your payment history, credit utilization, and the age of your accounts. Improving your credit score is a process that takes time because it is a gradual process. Positive actions such as paying bills on time on a continuous basis, reducing debt, and keeping a low credit usage take time to show results. This is because credit bureaus update scores based on monthly reporting from lenders, and earlier bad marks gradually lose their significance over the course of years. Maintaining good financial habits on a consistent basis, such as keeping accounts open and avoiding unnecessary credit inquiries, results in the gradual development of trust with lenders, which ultimately leads to gains in your creditworthiness that are long-lasting. Patience and consistency are therefore essential. Number 1. Be patient. Because it is a reflection of your long-term financial behavior, including your payment history, credit utilization, and the age of your accounts. Improving your credit score is a process that takes time because it is a gradual process. Positive actions such as paying bills on time on a continuous basis, reducing debt, and keeping a low credit usage take time to show results. This is because credit bureaus update scores based on monthly reporting from lenders, and earlier bad marks gradually lose their significance over the course of years. Maintaining good financial habits on a consistent basis, such as keeping accounts open and avoiding unnecessary credit inquiries, results in the gradual development of trust with lenders, which ultimately leads to gains in your creditworthiness that are long-lasting. Patience and consistency are therefore essential. Thanks for watching and subscribing channel.